Okay. So the next rule. So we talked about cash. We talked about number of position size, right? For stock, I use spiders as an index. If you trade in individual stock, it would be the same idea, right? You would look at the immediate support, right? If you're day trading or a little bit longer, you find, or you can just say spiders, right? If spiders drops below this level, if you have average technology stock, average, value stock, it's also going to drop, right? So you use these levels to potentially trigger your exit from other positions. And always the same amount, right? Doesn't matter, you trade in Bitcoin or you trade in something more volatile or less volatile. These are your risk levels. So risk management is extremely important. The second rule is if you trade in options, what strike price to select, right? So if you trade in spiders, I propose not to have $40,000, right? So if you have $40,000 account, then you can buy one contract of spiders, right? Because even if you buy a call or you buy unless you're trading spreads, right? You can do a $5 spread on spiders. It's a liquid name, and basically say, okay, I'm not gonna, if I lose half of the spread, $250, then I'm out. You could, but I propose still, because you want to treat it as a cash secured put. At least I like to do this. Then you just don't trade on a $40,000 account. You trade spiders. On a $28,000 account, if you have 28K, then you're trading QQQs, right? Because one contract is 28,000. So even if you're trading spreads, it's still a derivative of the option. 1% move on spiders, you down $4, right? 1% move on QQQ, you down $2.80. Irrelevant, your position size, right? So on a $10,000 move, if you're trading spiders and it's moving 1% down, then you're down $4. Here it's $2.80. So on a $10,000 account, 1% moving QQ, which happens every day, then you're still within limit of $250. But on spiders, $400, that's outside of your limit. So very quickly it can move 1%, and you're already down more than the rule that you specify. So then you just don't trade spiders if you have $10,000 account, right? You trade maybe CSX, right? Or some kind of ETF. I propose XLK, right? XLK is pretty liquid. It's pretty highly correlated to QQQ and spiders, so it's a $120 stock. So strike price selection is very important, right? So on the $10,000, if it's CSX, okay, then you do 3 contracts, because that's 103 contracts, right? If you're doing silver, then it's 5 contracts. Assume the same beta, right? Same volatility. But number of contracts, again, very common mistake. This is where you can get in trouble, right? If you have multiple position in spiders, $10,000 account, you have spider spreads, you have QQQ spread, and something else spread, or SMH spread, and then all of a sudden the market move 1%. Well, you're down $400 here, $200 here, and $200, and that's what you can get you in trouble. So strike price selection is the final rule, right? So again, I think the recipe for successful trading is, one, have a clear opinion on cash, right? Second opinion is on number of positions. Third one is, your drawdown, right? Your stop loss, right? So your stop loss, that's the 2.5% of account value. Some people say, well, I always do 5% of underlying stock, but it has different beta, right? Different stocks move with different correlations, so you can't just do 5%. 5% on Procter & Gamble, it might take 3 months for Procter & Gamble to move 5%, but Tesla moves 5% every day, right? So then it's different. So that's why I use account value. And the fourth one is a strike price selection if you trade in options. So if you've mastered these rules, right, it doesn't happen overnight. You want to internalize this information, right? If I wake you up tonight in the middle of the night and ask you what are the 4 foundations or pillars of successful trading, right? what are those elephants named? Those 4 elephants that are holding the earth are, or trading, is cash, number of positions, position size, and then strike price selection if you trade an option. Everything else, I think, will follow, right? Everything else will follow. You can find the services that give you signals. You can find the services that give you view on the market. But if you're not doing this correctly, if you're either overdoing it or underdoing it, then it doesn't really matter how good are the signals or how good anything else. At some point, if you have too many positions, you're gonna get caught, right? It's like the game catch me if you can. Sometimes bull market lasts, a few years and you don't get caught, but in this market, in the bear market, 90% of the people get caught, right? This is where you have to come to, I don't know what the right term is, but be honest with yourself and realize that you could have been lucky for the past few years during the bull market, and that's why your portfolio continues to grow. But in bear market, when market can move 20%, 30% in a matter of a couple of weeks, if you don't have those rules and you don't follow them, then that's kind of like a game of catch me if you can, right? At some point you're gonna get caught. At some point you're gonna get caught. So if you don't want to get caught, then these are the rules. And again, the reason I do 4 and 2.5, because again, psychology. 4 times 2.5, that means at any given point your portfolio can move up or down 10%. If your portfolio moves up or down 10% in the volatile market, I mean, it's not, it's still hard and it's not super pleasant, but you can live, you can manage that, right? If market is dropping 30% and your portfolio is dropping 30%, well, then it's a problem. It's very hard to recover from 30% drop. And when portfolio moves 20, 30% every 2 months, well, that, it's very hard to deal with that type of volatility.